Hey everyone, I'm Cary Smith and I'm sitting here with Amar Shah. We're both with Client First Capital. And Amar, today we're talking about interest rates. And more specifically, the Feds just dropped the interest rate, first time since 2020, right? So it's been a while. But a lot of times when, there's a lot of news and there's a lot of talk, but it's common for retirees when things change like this to have questions of how does that impact me? How does that impact my investments? How does that impact my income, my savings, my spending? So today we're going to talk about the drop in interest rates and how that impacts retirees.
Yeah, and I think that's a great topic because a lot of people are concerned because we went into this raising interest rate environment, which then bonds and CDs were finally paying some level of interest, right?
Right.
And now we're going the other way around. So I think the first thing that we can expect is that savings accounts, CDs, or even bonds that are new issue will likely have a lower rate with the decrease in the Fed funds rate. Lower rate in these type of investment grade type products could be a problem from some that have a large portion of their funds dedicated to like bonds and CDs, right? So
Mm-hmm.
it may be, you know, so two things. One, it may be if you already have a lot of bonds, you may see some price appreciation, but your yield will go down. And if you're buying new bonds, right, and you're not going to find the same interest rate that you once had.
Yeah. So if you're in something that's paying an interest rate, if it's guaranteed, you're probably good for now. But once it matures and you go to buy another annuity or CD or bond, right, you're likely going to see a lower return as you as you as you as those mature and you go to look to replace those. Okay. Um, so so we would expect to see that. How about how about impacts that one might see in the non-bond or fixed income part of their portfolio. So with it seems like with the interest rates dropping, there's an underlying message that says we have some confidence in our economy. And so that would equate, I would think, to maybe some positive changes that could offset the decrease in interest rates for bonds and CDs and such.
Yeah, so like the disparity from the risk-free rate into actually taking on risk and being in the markets, yeah, it's something to reevaluate. Is now with rates lower, can you still take the same level amount of risk that you're taking to meet your plan goals, right? I
Right.
think a lot of times retirees maybe get pushed into taking on more risk, right? Than they may feel comfortable with, but it may be a necessity to meet their plans work, right?
So it
Um,
might be, and so maybe it may not necessarily be a time to take on more risk. It may or may not, but it probably is a good time to relook at your portfolio and see is there some rebalancing that I need to do to make sure that I'm aligned with the appropriate risk levels.
yeah, exactly. So is the risk that I'm taking on appropriate for me at this point? Because now your bond portfolio may be a little bit larger than it was before, right? Because the yields go down, bond prices come up, and so you may need to sell some bonds, purchase some more equities, just as a broad example. Another thing, I guess, like with what you said earlier, like with annuity rates, if you bought an annuity in the past, you probably locked in that rate. But one thing is that when you bought that annuity, you also could look at the annuitization rate, right?
Mhm.
And so the comparison in for future years will be is my annuitization rate that I've locked into this contract, how is that different from the current environment, right?
Right.
So for people that are just looking to retire and they say, hey, I want a piece of my nest egg that is in safe pension-like income, well, those payouts that you may have 6 months ago versus today may be different, in terms of what you would actually get in the break-even time period.
Yeah. So another thing that we've seen with the interest rates being high is we've seen a lot of stagnation in the housing market, right?
Mhm.
So for a lot of people, they didn't love their house maybe, but they love their 3% or 2.5% mortgage.
Guilty.
Right.
Yeah.
And so now maybe we see some movement in the housing market. And so I think one, if you're looking to buy a house, um, there could be more inventory because people could see the market starting to move, and people who have been wanting to move or downsize or move to another place or live closer to the kids or grandkids, now they might be thinking about that two for two reasons. One, it's there'll be more buyers in the market now that people can mortgage rates are coming down and people be a little more comfortable with the interest rates. So just your thoughts on the housing market.
Yeah, housing is hard to kind of discover for many reasons, right? We got three different factors are involved with real estate, right? So like the first factor I would say is that um, during the Great Recession, so think about 2007, 2008, a lot of home builders have exited the business, right? They were wiped clean. So we don't have as many home builders. So there's this big supply chain issue with building enough homes for people, right? So that's
Right.
one like global macro factor, if you will. The second factor was interest rates, right? So like when interest rates were low, a lot of people went out and bought houses. Now the interest rates are higher, and you can't afford to move because the new payment's higher. Now we got this rate drop, and now all those people are starting to look to what can they be do, right? So you probably may have more competition, or there may be more buyers, like you said, but the market hasn't filtered that out just quite yet. And I would say like the third piece here is that when we look at real estate in general, it's such area dependent, right? So like if we look at a map of Florida real estate that is struggling due to homeowners insurance costs and weather, right? Especially right now as we speak.
Right.
We look at Austin, right, where a lot of people relocated during the pandemic, and the volume of people moving in pushed prices up, and now the volume of people moving in is not as high. So that there's some factors there, and even Phoenix, right, where there were a lot of Airbnbs and stuff like that that were used in the winter, and now that demand for that is changing. So it's hard to say with real estate, right? But I agree with you. This could be a potential opportunity to refinance into a lower rate if you had a higher interest rate loan. It could be a potential to sell and to downsize. There could be some factors in there, or relocate to grandchildren, right? Who
That's right.
may live in an area that now you could sell your house at a higher price and take that equity, and then maybe have a cash price on a condo or something like that. Yeah.
So, other impacts, the whole purpose of raising the interest rates to begin with was to control inflation. And now that the rates are coming down a little bit, how do we see that potentially impacting inflation? And so I know I'm asking the question, but it seems like we might see an uptick because once the rates drop down, there's some consumption begins to happen in the economy, and I would think that we would expect maybe a little rise initially before it goes back down, just because there's some pent up demand, and we may see greater investment and movement in the economy. But curious what your thoughts are.
Yeah. So obviously we get the same data, so we're in agreement, right? And so like I think the Fed, with this rate cut, potentially another rate cut in a couple months and 6 weeks here, could set the stage for inflation to reaccelerate mid next year.
Yeah.
Because when you look at the CPI calculations and what the Fed is looking at, PCE, that data has a 2-year base factors, right? And so there is a lag in inflation coming down. Now it's come down, right? But now when we reduce rates, we're now creating a situation where inflation can reaccelerate mid to late next year. So
Yeah.
it's interesting to see. Nobody has a crystal ball, but like a lot of things that the Fed is doing around inflation, kind of have actually worked out, for right as of right now, right? And so to be continued to look at this more, right? But when we look at inflation, we could have set the stage for reacceleration of inflation. So then what does the Fed do, right? Because they've been in a tight position with quantitative tightening, now quantitative easing, and now, we're going back to a little bit of less restrictive policy.
Yeah. Okay.
Yeah.
So let's wrap this up with maybe what are the three takeaways that retirees might experience or have to deal with the lower rates. So one is, if you're getting income from interest rate
Sensitive investments.
right, then you would expect that income would drop down slightly, right? You would expect some impacts there. Maybe it's a good time to reevaluate your portfolio and see if you need to rebalance. And are there some opportunities in the market there that weren't before that, or maybe you should even look at taking on more risk?
Yeah, reevaluate the amount of risk that you're taking. Yeah.
Yeah. Okay.
And then the third thing is just housing, right? And how that plays into your overall financial picture, not just financial picture, but enjoyment of life, being close to grandchildren, moving to different states, downsizing, all impacts your financial plan.
Okay. Very good. Okay, so that's at least some of the impacts that retirees would expect with the lower interest rate. And so, hey, I'll let you close this out.
All right. So if you enjoy this content, please hit the like and subscribe button. It helps other individuals like yourself find our content. If you have specific questions that are related to your situation, please visit our website, clientfirstcap.com. And at the very bottom, it has our phone number, emails, and all the other contact information that you could want. Thank you for watching.
All right. Thanks, Amar. See ya.
Yep. Bye.